Hi and welcome to the latest edition of Magellan Minutes. My name's Felicity Haynes, Head of Retail at Magellan, and today I'm joined by Al Pullen, Portfolio Manager. Hi Al.
Hi Fleck.
Al, interest rates continue to be a key influencer on the markets. Where do you see the markets heading in the near term, and what are the key drivers?
Yeah, interest rates have obviously been vital to markets this year. We have seen the US start to cut interest rates with a big 50 basis points cut first up. The economic data, which has really been driving that, the soft landing narrative has really been playing out this year. And the employment data has really been key to where we go with rates going forward. And with the latest data being quite solid after a couple of soft ones, I think that points to a slower pace of rate cuts going forward for the Fed. So maybe 25 basis points over the two remaining meetings this year. That should still be supportive for the markets, for that soft landing narrative, but it'll of course be very data dependent going forward. Now, when we think about markets, we always also want to think about the 10-year yield. That's the longer term rate, which tends to provide a bit of a proxy for the risk-free rate and does move markets around, probably more than that short-term Fed funds yield. And that's currently in that 4 to 4.5% kind of band, where we see as a longer-term kind of anchor at the moment. So we think that's about fair. We see interest rates staying, long-term rates staying at about that level, and it really come down then to the individual stocks, and that will be driving markets going forward, as opposed to rates, which have had an outsized influence the last couple of years.
And what about the impact of the upcoming election for markets?
Oh yeah, of course. We're less than a month away now. I'm kind of sick of hearing about the election, so it'll be good to get it done and out of the way. But it's obviously a risk vector for markets as well that we're thinking about. When we think about the outcome of the election, I think the risk here is about a clean sweep for either party. So that's where they win both the presidency, obviously, but also the House and Congress. So if they get that clean sweep, that gives them a free rein on policy. And that could be quite bad for markets, because some of the policies that they've got, big spending, could drive up interest rates, as we've talked about, could impact that long-term interest rate, and could be quite poor for markets. So we're not making a big call on who's going to win. Trump's probably slightly better for markets in that he's well known to be low taxes, lowered the corporate tax rate, for example. And he's got a policy out there to lower it further, whereas the Democrats obviously are looking to potentially raise corporate taxes. So what we want to see really is that we don't get that clean sweep, that one of the parties has the Senate, as opposite to the White House. And that means it'll be harder to get those more controversial policies through, which is probably a pretty good outcome for markets overall.
And what about banks? We don't hold any in the portfolio, but is that likely to change in the near term?
Probably not. Just given the defensive nature of the portfolio and all the downside protection that we build in, banks do have a pretty high bar to make it into the portfolio. There are some pretty good quality banks around the world, so we do cover select banks in the US, in Europe, but it's a pretty small number. They're just not as high quality as many of our other stocks. If you think of your Microsofts and so on. They can play a role within the portfolio because we think about macroeconomics a lot, and they are leveraged to that economic outlook. So from time to time they can play a role, but at the moment we do see kind of still that potential downside scenario in the US. While a soft landing is certainly our base case, and the data has been pretty supportive of that so far. There is a risk of a harder landing. We've got that at about 30% at the moment as a risk. And in that scenario, the banks, obviously they're just quite cyclical. They just take quite a hit in that kind of scenario. So at the moment, to ensure we have that downside protection, no banks in the portfolio. We're monitoring them. Their results season have actually been pretty good so far. They're doing okay. Their credit costs are okay at the moment, but it's about looking forward and the various scenarios that might occur. So not at the moment, but we'll monitor them.
But there are financial companies that are sort of on your radar. Do you see that there are some opportunities there?
Yeah, absolutely. Now, we've had some incredibly high quality financial companies within the portfolio today. So think about the payments companies, Visa, MasterCard, Brookfield, and we've got ICE, which is a futures exchange. So we still really like those companies, great long-term opportunities there. Maybe a quick update on each. So the payment companies, Visa is obviously one of those, very dominant. News there is that they're facing an antitrust investigation from the Department of Justice in the US. We like companies who have incredible market power, and they have about a 60% market share in debit in the US. So incredible market strength. That's great as an investor, but it does attract the attention of the authorities from time to time. So we've looked into this case, we've read the DOJ complaint, and I got to say, it's kind of mixed. Clearly, they're using their market power to kind of drive their returns in that market. But some of the allegations that they're offering volume rebates, for example, seem like pretty common market practice. So, this is something that we think they can manage through, even if they're some of their contracts that they have to renegotiate. They compete really hard on acceptance, on things like fraud. So we still think they'll be highly competitive in that market. And really, to be honest, this is going to take at least 3 years to kind of play out in terms of the litigation and the case. So it's a long-term risk, but one we think is pretty manageable for that company. Probably gives us a slight preference for MasterCard between those two companies at the moment, but they're both very attractive companies over the long term. Brookfield is another one. That's an asset manager in the alternative asset management space, which is still growing really strongly as people move into private credit and so on. They're really strongly placed within that. It's been a great performer this year, really a solid performer for the portfolio, but we continue to see great value in that stock as they continue to attract record flows into their private assets, and they've got a very attractive valuation, notwithstanding the strong performance they've had this year. So another one we're pretty confident in. The final one is ICE, Intercontinental Exchange. Less known to people perhaps. You see Brookfield buildings around the city, and everybody knows Visa and MasterCard, but ICE equally good.
They have the New York Stock Exchange.
And yes, and of course, they do own the New York Stock Exchange. That's actually a pretty small part of their overall business mix, where they have futures exchanges, which has been driving really solid profitability given some of the volatility that we've seen in things like energy markets. People use their futures exchanges to manage that volatility, to offset that risk or speculate on those price fluctuations. So they've been doing very well. And we've talked before about the opportunity they have in the US mortgage market, where they dominate the technology underlying that mortgage market. That's been a little soft as we've seen interest rates really, the high level of interest rates decrease people's willingness to take a new mortgage. If rates are high, there's less refinancings, less mortgages taken out. That's been a little bit of a headwind over the past year for that division. But looking forward with lower rates, that's likely to switch into a bit of a tailwind. So the stock again has done very well for Magellan unit holders, very well in the portfolio. And in terms of valuation, we have trimmed it a little bit, but over the long term, still a very attractive company.
Thanks, Al. That was a great update. And thank you for joining us today. If you have any questions, please reach out to the Magellan distribution team, and please feel free to share this video with any colleagues.